What if I told you there's a way to own a piece of every major company in America, Apple, Google, Amazon, Microsoft, all with a single click and for less than the cost of a pizza? An invention so powerful, it has been called the single greatest financial innovation of the 20th century. Welcome to the world of ETFs, or exchange-traded funds. They are the revolutionary tool that has democratized investing for millions. Today, we're going to uncover what they really are, how a single ETF nicknamed the Spider changed the game forever, and why they are the bedrock of most modern investment portfolios. By the end of this video, you'll understand why trillions of dollars have flooded into ETFs, how they give you the power of instant diversification, and why they are considered the simplest and most effective way for most people to build long-term wealth. Let's demystify this. An ETF is a fund that holds a collection of assets like stocks, bonds, or commodities, but trades on an exchange just like a single stock. Think of it like a sushi platter. You could go to the fish market and buy individual pieces of tuna, salmon, and eel, trying to pick the best ones yourself. That's like buying individual stocks, or you could buy a pre-made platter curated by a chef. You get variety, it's simpler, and your risk of picking a bad piece of fish is much lower. An ETF is that platter. For example, an S&P 500 ETF is a platter that contains shares of the 500 largest companies in the US. When you buy one share of that ETF, you are instantly buying a small piece of all 500 companies. Diversification. It bundles hundreds or thousands of investments together, so you aren't putting all your eggs in one basket. Tradability. You can buy and sell it throughout the day, just like a stock, giving you flexibility and liquidity. Before 1993, if you wanted to invest in the whole market, your only real option was an old-school mutual fund, which was often expensive and could only be traded once per day. Then, on January 26, 1993, a new product was launched, the SPDR S&P 500 ETF, ticker symbol SPY. It was nicknamed the Spider, and it was a total game changer. For the first time, any investor could buy the entire S&P 500 index with a single share and trade it all day long. The impact. It was revolutionary. It took the power of market-wide investing out of the hands of expensive fund managers and gave it to the people. It was cheap, it was transparent, and it was easy to understand. The Spider was so successful, it kicked off a massive revolution. And today, SPY is still one of the largest and most actively traded ETFs in the world. These are the classics like SPY. They are passively managed and simply track a major market index like the S&P 500, the Nasdaq 100, QQQ, or the entire world stock market, VT. They form the core of most long-term portfolios. Want to bet on a specific part of the economy? You can. Sector ETFs let you invest in just technology companies, XLK, healthcare, XLV, or financial banks, XLF. You can get as specific as you want, from cybersecurity ETFs, hack, to robotics ETFs, BOTZ. ETFs aren't just for stocks. Bond ETFs let you buy a diversified basket of government or corporate bonds. They are a great way to add stability and income to your portfolio to balance out the risk of stocks. This is the number one benefit. By buying one share, you can spread your risk across hundreds of companies, industries, and even countries. This protects you from a single company's bad news devastating your entire portfolio. Because most ETFs are passively managed by computers that just track an index, their fees, called expense ratios, are incredibly low. The average ETF costs a fraction of what an actively managed mutual fund costs, saving you thousands of dollars in fees over your lifetime. Unlike mutual funds, which might only report their holdings quarterly, most ETFs are required to disclose their holdings every single day. You always know exactly what you own. Let me tell you about John Bogle, the founder of Vanguard. His philosophy was simple but radical. Trying to beat the market is a loser's game for most people because of high fees and bad timing. His solution? Don't look for the needle, just buy the haystack. He championed the idea of the low-cost index fund. Instead of paying a genius manager to pick stocks, just buy an ETF that tracks the entire market. Keep your costs as low as humanly possible and hold on for the long term. Vanguard's low-cost ETFs, like its total stock market ETF, VTI, have saved investors billions of dollars in fees and have become the gold standard for passive investing. The Boglehead philosophy proved that sometimes the simplest strategy is the most powerful one. ETFs are one of the most powerful tools ever created for the average investor. They offer instant diversification, rock-bottom costs, and the simplicity of trading like a stock. But this simple, safe tool has a dark and dangerous side. There are exotic ETFs out there designed for pure speculation, leveraged ETFs that can wipe you out in a day, and thematic ETFs that have crashed spectacularly. If you want to learn about the volatility decay that eats leveraged ETFs alive, how the queen of thematic investing saw her fund collapse over 70%, and how a flash crash caused some ETFs to trade for a penny, make sure to subscribe and hit that notification bell. Trust me, the stories of ETF disasters will show you what happens when a great idea is pushed to a dangerous extreme.